We are talking about limited companies. Limited companies means the shareholders have limited liability.
हाँ.
Okay. So when I'm doing any business, limited company is more popular to the partnership. Why it is more popular to the partnership? Because in limited companies, you can ask your shareholders to pay for your capital. They will buy the shares, they will invest in your company, and they will become the shareholders of your company. And they become the shareholders of your company. When I talk about the features of limited company, there are some few features that you should know. It has a separate legal existence. What does this mean? Company is
Uh,
separate, owner is separate. Company is separate,
yeah,
owner is company is separate. The shareholders are separate. Company is owned by the shareholders. It is managed by the directors. It is
yeah.
managed by the directors, and these directors are appointed by the shareholders to look after the company.
Okay.
When the directors are looking after the company, they are performing their stewardship function. Which function?
Stewardship function.
Okay. Another feature of limited company is that it has limited liability. That means the shareholders will, if any money will go away, would be restricted to the amount that they have invested in the shares.
Yeah.
Shareholders die or they live, it does not affect the continuity of the business. Shareholders' health, death will never affect the continuity. So the business goes on and on and on, irrespective of the life of the shareholders.
Okay.
Limited company issues shares to the public. This is the only benefit of limited company, is that they can ask people to invest money in their company.
Hmm.
Limited companies have to publish their accounts. That means they have to call the shareholders, they need to show the shareholders what they have done, and it has to be published with the registrar of companies. That
Hmm.
means of any limited company, if you want to see their books of accounts, you can go to the ROC and get it.
Okay.
Okay. You have two types of limited company: private limited company and public limited company. Okay, when I'm talking about public limited companies, the capital of the company is divided into shares. Yeah,
Okay. Yeah.
these shares can be issued to the shareholders at par. When I say the shares can be issued at par, that means a share of $10 is issued at $10.
Yeah.
Okay, if I say the shares are issued at premium, what does this mean?
That shares of $10 are issued for like 11, 12.
The people who are going to buy the shares of my company is called the shareholders. Liability of the shareholders will be,
Liability of the shareholder as in? I don't understand.
okay, if I buy shares of a limited company, what could be my maximum liability if the company does not work as intended?
The limited. कितना ही
Limited.
है.
Limited up to
Yeah.
what? The liability of the shareholders is limited to the amount they have invested.
Yeah. Okay.
That means if anything goes, only my amount invested would go away, nothing more than that. And what is the amount invested? The amount invested in the limited company is my capital that I have shared.
Yeah. Okay.
Okay. A private limited company. Private limited company means that is also a limited company, but a private company have maximum number of members limited to 50.
Okay.
Okay. A private limited company cannot issue shares to the public. They cannot issue shares, they cannot issue debentures. What is debentures?
Debentures is like
Loan.
loan.
Debentures
Yeah.
like loan. Name of loan is called debentures. Okay. All my
Uh,
public limited companies, they are traded on my stock exchange. Okay. Public
yeah.
limited companies, they are known as listed companies. If they are listed companies, they have to comply with stock exchange requirements.
Okay.
Okay. Public limited companies can arrange their funds from where? They have some internal sources of finance and they have some
And
external
external.
sources of finance. So a
Hmm.
public limited company can arrange funds from the internal sources of finance would be the share capital. Okay.
Okay.
And reserves. What is reserves?
Like revenue reserve, general reserves, and all that.
Yeah, so reserves is the profits that they keep aside in the business for further expansion of the business. So limited companies can be funded by internal sources of finance, that is the share capital and reserves, and the external sources of finance would be their debentures, loans, bank loans.
Okay.
What is
Got
debenture?
it.
Debentures are loan that is taken from the public.
Yeah.
Now, any limited company would have two types of share capital. One type of share capital is the ordinary shares and other is preference shares. What
Hmm.
is preference shares? They will always be mentioned 9% preference shares or 10% preference shares. Preference
Yeah.
shares are shares that carries a fixed rate of dividend. Okay,
Okay.
9% or 10%. That is why we always treat these shareholders as outsiders, because preference shareholders have to be given dividend irrespective of profits. Profit is there or it is not there, preference shareholders have to be given whatever percentage is decided as dividend.
Okay.
That is why whenever we do finance cost, we have two finance costs that is fixed. One is preference dividend and one is interest charges.
Hmm.
Are you with me?
Yeah.
So preference dividend carry fixed rate of interest, and when the company is winding up, they are paid first. So whenever I have to calculate the dividend per share or the earning per share, I always take which shareholders into consideration? My ordinary shareholders into consideration. Okay. So when I
Yeah.
am calculating the dividend per share, I take my ordinary shareholders into consideration. What is the formula for dividend per share? It is the annual
Annual.
ordinary dividend divided
Uh.
by the number of ordinary shares.
Yeah.
So that is why when I want to calculate dividend per share, I only take the ordinary shareholders. I do not take the preference shareholders because
Because they get a fixed percent. Unka is fixed.
their dividend is fixed. Even if I
Yeah.
want to calculate earning per share, how do I calculate the earning per share?
Earning per share, you have to do a profit for the year upon number of issued ordinary shares.
Upon number of issued ordinary shares. Okay. Preference shareholders, just read about it. Can you please read?
Yeah.
So preference shareholders, they're getting fixed rate of dividend. They do not have any voting rights. And you have two types of preference shares. One is cumulative preference shares and one is non-cumulative preference shares. Now, what
Okay.
is cumulative preference shares? You just need to know about it.
Hmm.
Okay. My preference shareholders are 9% preference shares. What does
Okay.
this mean?
It's like
Preference
they
shares are going to get dividend at the rate of 9%.
9%. Yeah.
In my year one, I have made no profits.
Okay. So year two में that 9% will be carry forward.
Okay, in cumulative, this 9% I will have to give them a cumulative effect. Like in year two, if I've made profit, first I will give them dividend 9% for year one, and then I
Yeah.
will give them 9% for year two
Okay. Hmm.
in cumulative preference shares.
Wow. Okay.
But in non cumulative, no profit, let the dividend go away.
So year one ka profit will not be counted in
Yeah, it is not
non-cumulative.
cumulative.
Okay, fine.
Okay, so these are the two types of preference shares, cumulative and non-cumulative. What are the two types of shares?
Ordinary shares and preference shares.
Okay, what is ordinary shares? Ordinary shares are those shares whose dividend is not fixed.
Huh.
Preference shares, dividend is fixed. Okay, ordinary shareholders are paid only after giving dividend to the preference shareholders.
Yeah,
But
okay.
ordinary shareholders have voting rights. Can you tell me something about debentures? Debentures are long-term loan which the company takes from public. Debenture carries fixed rate of interest. and debenture holders are the creditors of the company. Why
Okay.
the creditors of the company? Because the company has to pay them.
Hmm.
Debenture holders also do not have voting rights. So voting rights only one person has. Who is that one person who has voting rights?
The ordinary share people.
Ordinary shareholders. Preference shareholders, no voting right. Debenture holders, no voting rights.
Yeah.
Now, when you talk about reserves, what is reserves?
Reserves
Reserves
is
are
like,
profit kept aside.
yeah.
Okay, so whatever profit the company is earning, if the company is not distributing as dividend, then that profit is called reserves.
Yeah. Okay.
We have two types of reserve. One is the revenue reserve and one is the capital reserve. When I talk about revenue reserves are money that is generated from day to day operations.
Okay.
There are two types of revenue reserve. One is retained earnings and one is general reserves.
General reserves. Yeah.
A capital reserve is profit generated out of non day to day operations. Like when you're issuing shares at premium, securities premium becomes a capital reserve.
Okay.
If you're revaluing assets upward, like assets are there, you revalue them. Because of revaluation, you receive a profit. You revalue the assets upward. Then this profit would go in a reserve which is called a revaluation reserve.
Yeah. Okay. Fine.
Okay, so there are two types of reserves, revenue reserves and
Capital reserves.
and capital reserves. So for revenue reserves, you will remember profit and loss account, retained earnings.
Yeah.
Okay, and capital reserves, they come from non-trading activities, non-operating activities.
Okay.
Okay, what is share premium?
Share premium is basically when a company is issuing shares like above the price.
Above the face value. Okay,
Yeah.
if I say I have shares of $10 and I issue at $12, so the money that would go in my share premium would be $2
Yeah.
multiplied by the number of shares. Now, when I am using this profit, this capital profit, I can use it only for specific purpose. There is a restricted use for share premium. Four uses. You can use share premium only for four purposes. To write off preliminary expenses, to write off share issue expenses, any commissions that you are paying, uh, so that you can offer the shares at a discounted rate, and to give bonus. You
Okay.
Preliminary expenses are the expenses to form the company.
Huh.
Okay, if I want to use any of my profits to write off these expenses, I can use share premium. If I want to give bonus, I can use share premium. What do I mean to say that I can use share premium? See, what is bonus issue?
Bonus is when like the shareholders get like
When
bonus.
shares are given free of cost.
Yeah.
Okay, I am giving the shares free of cost to my shareholders.
Okay.
If I am giving the shares free of cost to my shareholders, what does this mean?
It means that,
The share capital is increasing.
yeah.
If I say the share capital is increasing, means share capital is credit.
Huh.
Again, I want to recall what is bonus.
Giving shares to shareholders free of cost.
I am giving shares to my shareholders free of cost. That means my share capital is increasing. Share
Yeah.
capital is increasing, but is money coming in?
No, money is going out.
Why money is going out?
Because you're giving free now, you're not getting the capital.
But money is going out.
No, sorry, the shares are going out. My bad.
Shares are not going out. You are issuing shares, shares are coming in.
Okay.
Usually, when you issue shares, when you issue shares, your money has to come in.
Huh.
That is how you create capital, right?
Hmm.
Okay. Your capital is not created. Capital is being increased, but money is not coming in.
Okay.
Money is not coming in. Bank is not coming in. So something has to be debited.
Yeah.
So instead of money, you use your profits, and the name of the profit is share premium.
Okay,
So
got
you
it.
debit the profit. Now understand profits have what balance?
Profits have a credit balance.
Okay. So if I am creating any profits, I will do what? I will credit it.
Yeah.
Okay. But if I'm using the profits, what will I do?
Then you will debit it.
Then you will debit it. See, if you're creating profits, you're going to credit it. But if I'm using the profits, I will do exactly reverse. I'm using the
Yeah.
profits, so I will debit the profit.
Hmm.
So when I say that I'm using share premium to give bonus shares, okay, when I am using premium to give bonus shares, I am actually creating capital
Yeah.
and the money is not coming in. I'm just using my profits. Giving you 2 minutes, digest.
Yeah.
Is revaluation reserve. Revaluation reserve is that you are revaluing your assets. If you are revaluing your assets, say the value of your asset is increased.
Hmm.
Okay, value of the asset is increased, so asset account will be debited.
Value of debited, huh?
If the value of your asset decreases, so asset account will be
Credited.
credited. Now, if the value of the asset has increased, that means you've made a profit.
Yeah.
This profit will go into which account?
Retained earnings.
This profit will go into revaluation reserve.
Hmm.
That is what we were trying to tell. If the value of the asset increases, this profit will go into revaluation reserve. If the value of the asset decreases, then
Then this will go lost, mein, na?
so where will you write off this from?
Revaluation reserve?
So you will do revaluation reserve debit. Now
Yeah.
understand, I'm again and again telling you this point that whenever you are creating a profit or whenever you're creating profits, whatever is the name of the profit, here the name of the profit is revaluation reserve. It will be credited because
Yeah.
profits always have a credit balance, debit all expenses and losses, credit all incomes and gains.
Okay.
However, when you're using the profits, what you're using the profits, you're using the profit to write off the loss on revaluation. I'm repeating, you're using the profit to write off the loss on revaluation. So you will do
Okay.
revaluation reserve debit. Take again a minute time. When you're creating profits, what will you do?
You'll credit it.
Okay, and when you're using the profit,
Debit.
so profits are used. When I'm talking about profits here, I'm specifically talking about reserves.
Yeah.
Reserves are used to write off something.
Hmm.
Okay, now general reserves. What is general reserve? General reserve is a free reserve. Now understand, whenever you get profits, where do you transfer the profits?
You transfer it to
Retained.
retained earnings.
From the retained earnings, what do? You retransfer it, you retransfer some money to general reserves. Why do you
Yeah.
do that? Because whenever the money is lying in the retained earnings, the shareholders will demand dividend.
Yeah.
Dividend is paid out of retained earnings. Retained earnings is a clubbing up of all your profits together. So whenever money is there in the retained earning, your shareholders will demand dividend. If they
Okay.
are demanding dividend and money is there in the retained earnings, you have to pay them dividend. So what
Yeah.
they do, they transfer some money away from the retained earnings and they put it in the reserves, which is called the general reserves.
Hmm.
So in future, if you don't make any profits or in future you want to expand or in future you want to pay dividend, you can retransfer from here to retained earnings to pay dividend, or you can use money in the general reserves for specific purposes like expansion or future requirements.
Okay.
Remember, general reserves will not be used to pay dividend.
Hmm.
You just transfer money from retained earnings to general reserve for future requirements. If in the future you want to pay dividend and you don't have money in the retained earnings, you will retransfer from here to retained earnings and pay dividend from here.
Yeah. Okay.
Are
Got
you
it.
with me?
Yeah.
Retained earnings are your distributable profits. You are going to pay dividend only from the retained earnings. From the general reserves, if in the future you have to pay, you retransfer to retained earnings and pay.
Yeah, okay, got it.
But when you are preparing, this is actually that is done as per the Companies Act. But when you're preparing SOCE and you pay dividend, okay, you first use retained earnings, then you use general reserves.
Yeah,
Are you with me?
yeah.
Okay, fine. Now, what was I talking about? Yeah, capital structure. When I talk about the capital structure, you have authorized share capital. Authorized share capital is your registered capital. You register your company with this capital. This is the maximum number of shares that you can issue in your lifetime.
Okay.
Are you with me?
Yeah.
It is called registered capital, nominal capital, whatever name.
Hmm.
In your lifetime, this is the maximum that you can offer to the public to buy.
Got it.
Issued share capital is what you've actually sold out in the market. What
Hmm.
actual stock you have removed in the market for people to buy your shares.
Yeah.
Subscribe capital is what the people have actually bought.
Okay.
Okay, I might issue 1000 shares, but people might buy 500 shares.
Huh.
So, issued capital is what you've sold, what you've removed out and subscribed, it's what the people have actually bought.
Yeah, got it.
Called up capital is what I've asked the people to pay.
Hmm.
Okay, I ask them that you pay me this money, you pay me this money. Asking them to pay money would be in stages, and the name of the stages is application, allotment, first call, second call, and so on.
Yeah, got it. Huh.
Paid up capital is I ask them to pay, but what they actually pay me is called the paid up capital.
So they don't pay what you ask.
There might be some people like you who don't pay.
You are telling like I would don't pay. Okay.
I'm just kidding. When
Yeah.
you call capital, you create capital. Understand one thing that when you call the capital, you create the capital. Say
Yeah.
the face value of the share is $10. You cannot ask entire $10 together. So you divide the calling up process into stages. So say you call for $5. So whenever I'm calling the money, I will create capital. So I
Yeah.
called up 5, I created capital 5. Okay.
Okay.
I have received only $3. So $3 would be my paid up capital.
Hmm.
I created capital when I call capital. I'm repeating the statement again and again. I create capital when I call the capital. So I when I call for $5, I created $5 and I will show in my share capital only $5.
Hmm.
If people have paid me $3 would be my paid up capital and $2 would be my calls in areas.
Got it.
Calls in areas is that part of called up capital which people have not paid.
Okay.
Okay. Now, when I talk about the income statement of a limited company, income statement of a limited company would be sales minus sales return. I get cost of sales minus sales return. I get net sales
Net
minus
sales.
cost of sales. I get gross profit. Add
Hmm.
other income minus other expenses. Now, your
Okay.
expenses is divided into three parts. One is the office and administration overheads that would be in your working note number one. You will
Yeah.
never show it as a bifurcation over here.
Okay.
Working note number two would be your selling and distribution expenses, and working note number three would be your finance cost.
Hmm.
Finance cost would always include your interest element and preference dividend.
Okay.
Okay. When you get your profit before tax, from that you subtract tax, you get profit after tax or profit for the year.
Yeah.
Your expenses would be classified into three overheads, and your three overheads would be your three working notes: office and administration, selling and distribution, finance costs.
Hmm.
Before that, you have to show profit before interest and tax, which is called PBIT.
Okay.
Okay,
Hmm.
finance cost would include interest and
Preference share dividend.
preference share dividend. Now, this is your statement of changes in equity. I'm going to explain you this format over here. Statement of changes in equity. It statement of changes in equity only shows you the shareholders funds.
Hmm.
Shareholders funds, that means owner's equity. Owner's equity is made up of the share capital plus all the balances of your reserves.
Yeah,
Are
okay.
you with me? This
Yeah.
will include only the ordinary shareholders' funds.
Hmm.
Ordinary shareholders' funds, that means no preference dividend will come over here.
Yeah.
Okay. The normal columns of your statement of changes in equity is your share capital, share premium, general reserve, retained earning, revaluation reserves total, or whatever is given to you. But not more than this. You will not have any columns more than this.
Got it.
Okay. Over here, first line would be your balance at start, last line would be your balance at the end. This would normally be given to you, and this you will have to find.
Got it.
Sometimes they give you this and they ask you to find this. This would be rare scenario. What is your total shareholders funds? Your total shareholders funds in this case would be 1956. That
Ah.
is share capital plus share premium plus general reserve plus retained earnings plus revaluation reserve. This is your shareholders funds.
Yeah, this to okay.
Sometimes they ask you to prepare an extract of the shareholders funds from the SOCE. You will just take this, you will write share capital plus share premium plus general reserve plus retained earning plus revaluation reserves. Okay. Now your
Yeah.
SOC have your balance at the beginning, your profit for the year. Where will you write the profit for the year? In your retained
Under the
earnings
yeah, retained earnings.
in the retained earnings and the total. Then you have your dividend paid column. Dividend would be on paid basis. Dividend over here would be on which basis? Paid basis. Interim dividend of the current year, proposed or final dividend of the last year. Are you with me?
Yeah. Got it.
Okay, interim dividend of the current year, you will write, you will pay it from which place?
Interim dividend you will pay from retained earnings.
Pay from retained earnings, you will subtract from retained earnings, you will minus from the total.
Yeah.
Final dividend, you will take it for the last year, you will subtract from retained earnings, you will minus from the total. Profit for the year, you will add to the retained earnings, you will add to the total. Other than that, if you
Hmm.
put shares, so the face value of the shares would come in share capital, and the extra price that you have charged would come in share premium. Total would be the total.
Yeah, got it.
If you've given bonus shares,
Then also bonus shares will come like
bonus shares will increase your share capital. Say you've
yeah.
given bonus of 1000, it is going to increase, or I'll make it more smaller. You've given bonus of 100. Okay. So I will give bonus over here 100, increasing the share capital, and I'm going to use the money from share premium.
Okay, fine, got it.
Okay.
Yes.
Revaluation of assets. Your assets are revalued upwards or downwards, whatever it is, you're going to use some revaluation reserves.
Oh,
Transfer to reserves. Transfer to reserves happens from the retained earnings, it goes to the general reserves.
okay.
So you minus from retained earnings, add to general reserves.
Oh,
Statement of changes in equity only for the equity shareholders. Ordinary shareholders, it gives you your shareholders funds. This would be your shareholders fund. Now you go to your statement of financial position, you'll have your assets, non-current assets, current assets, total assets. Then you show your equity and liabilities, your capital and reserve, non-current liabilities, current liabilities, total liabilities.
yeah, okay.
Capital
Hmm.
and reserves is nothing but your shareholders funds.
Share, yeah,
Okay, so this is your balance sheet format. Your balance sheet format, non-current assets, current assets, total assets, equity and liability starts with the SOC, non-current liability, current liabilities.
okay.
Are you with me? I
Yeah.
hope you remember the format of your balance sheet.
Yeah, yes, I remember.
Okay, what is the debenture interest?
The amount that will like it's
That
already decided and it'll go as an expense.
yeah, so it is a preset percentage and it will come in the interest expense in the finance cost.
Yeah,
There is one example over here. Say your trial balance is telling you, your trial balance tells you that there is a 10% debentures. Debentures is a liability, so it comes on the credit. Are you with
yeah,
me?
yeah,
Debenture is a liability, it comes on the credit. And below that, they've given you debenture interest 5,000.
yeah, okay.
What does this mean?
This means that you've already paid this debenture interest.
Okay, so first you will calculate on 100,000, you're going to calculate 10%. That means
Yeah,
your debenture expenditure for the year is how much?
10,000.
Expenditure for the year is 10,000. So when in your income statement you are going to show debenture interest, you will show 10,000.
Yeah,
Okay. If you're making income statement, 10,000 would be your expenditure for the year.
yeah.
Okay. But your trial balance only shows 5,000.
No, this 5,000 was last year ka.
No, understand to me one thing. Five trial balance shows 5,000. That means you have paid 5,000.
Okay.
Okay. This is a hidden adjustment that will come. 10% debenture interest. That means your expenditure for the year is 10,000. Trial
Yeah.
balance is showing 5,000. That means you paid 5,000. 5,000 is yet to be paid.
Hmm.
5,000 is yet to be paid. It will come in your statement of financial position under the heading of current liability.
Yeah, okay.
Understood? Giving you break. Just think and tell. Now tax. Okay, remember you have your sales minus cost of sales. What do you get? Gross profit
Gross profit.
minus your
Yeah.
working note number one, that is office and administration expenses, minus your working note number two, that is your selling and distribution expenses. What do you get?
The profit before
Profit
profit before
with
interest.
PBIT. From the
Yeah.
PBIT, you minus your working note number three, that is your finance costs.
Yeah.
Finance cost includes what?
Like the percentage debentures and all.
Finance cost includes your interest and preference dividend. So you'll minus your finance cost. What will you get? You will get your profit before
Before
tax.
tax.
Remember this. After this, you're going to minus your tax. You will get your profit after tax or profit for the year. What I'm trying to explain you over here is that your working note number one, working note number two, working note number three is a charge on profit.
Okay.
When I say this is a charge on profit, whether you make profit or you do not make profit, administrative expenses has to be done, selling has to be done, finance cost has to be done.
Okay.
You make profit or you do not make profit, there is no relevance. This expenses has to be paid.
Got it.
Okay. But when you talk about tax, it is not a charge against profit, it is an appropriation of profit. When I say
Okay.
this is an appropriation of profit, what does this mean? That only when you're making profits, you're going to pay tax.
Hmm.
It is shown as a deduction from profits. It is going to be paid only if you have profits over here. If you don't have profits, you do not pay tax. Then
Okay.
there are certain things that you should know. What is preliminary expenses?
I don't know this.
Okay, preliminary expenses. Preliminary expenses means the first step expenses.
Okay.
See, whenever you are making a company, a nice company you're making, you might need to do certain expenses before the company is formed.
Hmm.
Okay. Before the company is formed, you are going to do certain expenses. Who is going to pay for the expenses?
Okay.
Who's going to pay?
The business.
But business is not yet formed.
The shareholders.
After the company is formed, I can issue shares.
So then who will pay for this? The owner?
Nobody pays. The promoter pays for these expenses. Promoter is the person who gets an idea that I want to start a company. He is not yet the owner of the company. The company is not yet formed. The company is in the process of formation. So the
Okay.
expenses that you do to make the company before the company has actually come into existence is called preliminary expenses. I'm
Acha.
repeating, expenses that you do to make the company before the company has come into existence is called the preliminary expenses. Are you
Okay.
with me?
But
These
you promote. Okay, huh.
promoter करेगा. These expenses are later going to be removed from the profit after the company has been. Ask me your
Uh,
question.
Miss, so then when will the business pay the promoter back after the business is like,
After the business is set up. So what happens is promoter is the person who's getting the idea. He will make the company. After the company is formed, he is going to issue the shares. He is going to issue the shares. He is going to ask the people to come and buy the shares. So there will be some share issue expenses, and there will be other lot of expenses also which the promoter is going to do.
Yeah, okay.
For example, this promoter has done some expenses of 500,000. So what
Okay.
happens is when the company is formed, he is going to take this 500,000 again from the company. He can take shares from the company
Hmm.
free of cost and
Huh.
then use securities premium. That is what we learned. Securities premium can be used to write off share issue expenses.
Yeah.
It can be used to write off the preliminary expenses.
Hmm.
So what happens? This promoter is going to use securities premium. So he will do securities premium debit, preliminary expenses credit.
Yeah, got it.
So he's going to use the securities premium to write off these expenses.
Hmm.
Are you with me?
Yeah.
Okay, fine. Now, another thing, so preliminary expenses, then what is retained profit?
Retained profit is basically all profits that are kept from last year after paying everything.
What are the two types of dividend?
Interim dividend and final dividend.
What is interim dividend?
Interim dividend is a dividend that you're supposed to pay in the middle of the year.
Declared during the year, paid during the year.
Yeah.
What is final dividend?
Final dividend is dividend that is proposed in the current year, paid in the next year.
Okay. In the SOCE, which dividend will come?
In the what? I can't hear you.
SOCE,
Both, na?
interim of the current year, final of the last year.
Yeah.
Now, what is bonus shares?
Bonus share is free shares that are issued to shareholders.
Is the journal entry that you pass for issuing bonus shares?
You have to debit the share premium and credit the ordinary share capital.
Is any money coming in because of bonus shares?
No.
Okay, I want you to solve this example. I'm giving you time.
Okay, fine.
Now, understand this example over here. You have ordinary share capital of how much?
200,000.
You have ordinary share capital of 200,000. You have share premium 3,000 and general reserves 3,500.
Hmm.
Okay, you're doing bonus issue, one share for every four held.
Okay.
So this is one share for every four held. You make it as a fraction 1 over 4. How
Into
many shares are
200,000.
held? 20,000.
Yeah,
So
sorry.
20,000 shares were held. So when I
Uh,
say 20,000 shares were held, your bonus issue is 20,000 divided by 4. Your
yeah,
bonus
which is
issue is
5,000.
5,000 shares. So you're going to
Hmm.
give 5,000 shares as bonus. Recall the definition of bonus. Bonus is shares given free of cost to the shareholders.
Yeah.
So 5,000 will add to your ordinary share capital.
Yup.
From where will the money go?
From share premium.
Share premium. So if the money is going from the share premium, how much should go from the share premium?
How much is there? 3,000 is there, so 3,000 will go.
5,000 into 1, 5,000 should go. But
Yeah.
I have only 3,000 share premium, so 3,000 share premium will go and it will wipe off.
Okay.
Remaining is what? 2,000. 2,000 will go from my general reserve, so I am left with 1,500.
Yeah.
Okay. Now the journal entry would be I have created capital 5,000.
Hmm.
Capital is credit 5,000
Yeah.
and I'm using share premium 3,000.
Yeah.
I'm using general reserves 2,000.
Hmm.
Okay. So I will be left with what? My ordinary share capital will become 25,000.
Yeah. Share premium will become
Share
0.
premium is wiped off and general
Yeah.
reserves I'm left only with 1,500.
1,500.
Now
Got it.
understand over here, here I have done a thing where I am using my share premium first, I am using my general reserves next.
Okay.
I'm using my share premium first, I'm using my general reserves next, I'm repeating again. I'm using my share premium first, I'm using my general reserves next. That means I am using reserves in the most flexible form.
Okay.
I'm
Got it.
using the capital reserve first, revenue reserves last.
Huh.
Because revenue reserves I can use for other purpose also. I'm using my reserve in the most flexible form.
Hmm.
Are you with me?
Yeah.
Now I am talking about what I'm talking about, right issue.
Yeah.
What is a right issue?
Right issue is like that
Okay, I
the
tell you
shares
what
that I issue.
issue. I have shareholders.
Hmm.
Okay, my shareholders are already there, they're already existing.
Yeah.
Okay, and these shareholders have 10 shares.
Okay.
If I give them shares, say 5 shares free of cost, it will be bonus issue.
Yeah.
5 shares I'm giving them free of cost.
Hmm.
Okay, but if I am adding to the share capital another 8 shares and I am telling them that look, I want to issue some shares, but rather than issuing outside, I am giving you an opportunity to buy this.
Acha. Okay.
I am giving you the right to subscribe to these 8 shares before outsiders.
Okay.
Before selling it to outsiders, I will tell these 15 shareholders, do you want to buy shares? I have 8 shares. So when I give the existing shareholders the right to buy my future issue first, that is called right issue.
Got it.
Before going to outsiders, I will ask the insider, do you want to buy?
Huh.
But over here, they are not going to get these shares free of cost. They
Hmm.
are going to pay me for it. And they are also going to pay me a premium price for it. Understand what happens in right issue? My share is of face value 10.
Yeah.
Market price is 2000.
Huh.
I am going to sell this to my existing shareholders, shares of 10 at 15.
Hmm.
That means I'm going to charge them a premium, but very less compared to the market price.
Okay.
I'm going to sell my shares to my existing shareholders at a premium, which will
Got
still
it.
be less compared to the market price.
Hmm.
This is called right issue. You're giving
Understood.
the rights to your existing shareholders.
So
But
basically, you tell the existing people only कि come ले लो हमसे.
yeah, come le lo humse. What happens in the right issue is that the ownership is not diluted.
हाँ.
My existing shareholders are buying, no new people are coming in.
हाँ.
Ownership is not diluted.
Got it.
I am raising capital.
Yeah.
Money is coming in.
हाँ.
It's an internal source of finance.
हाँ.
Ownership is not diluted.
Hmm.
Okay, so this is all about right issue. So they might ask you to distinguish between bonus issue and right issue. Even this is given to existing shareholders. Even this is given to existing shareholders. But
Okay.
this is for a payment.
हाँ.
Over
Hmm.
here, the net assets do not. The net assets of the company are unchanged because you increase the capital and you reduce the profits.
Okay.
Okay, over
Hmm.
here what happens is that cash is received and capital is increased, so the net assets is changing. What is net assets? Net
Net assets are assets minus
capital.
liabilities.
Yeah, so it is the capital of the company, right?
Yeah.
Capital of the company in a limited company is the shareholders funds.
Yeah.
Shareholders funds is capital plus reserves.
हाँ.
So when you're doing bonus issue, what is happening? Capital is increasing, reserves is decreasing.
Yeah.
So shareholders funds, the net assets is not changing.
Oh, like that you're asking. Yeah.
But in the right issue, capital is increasing
Hmm.
and money is coming in. There is nothing, no profits are being used. Your profits would also increase.
Hmm.
Share premium would increase. So this is a difference between the bonus issue and right issue. And this is all with the theory of limited company that will help us to solve the adjustments.
Okay.